So when you're looking to invest your money, it can feel a little overwhelming, right? There are just so many choices. How do you actually get past all the noise and the hype to make a genuinely smart decision? Well, today we're going to break down one of the most powerful methods that serious long-term investors use to find real value. I mean, this is it. This is the big question, isn't it? When you look at a stock, how do you know if it's priced fairly? Is it a total bargain, or is it dangerously overvalued? To even begin to answer that, investors pretty much fall into two major camps, two different ways of looking at the world. So on one side, you've got technical analysis. These are the folks living in charts, looking at price trends and trading volumes. They're all about the what. What is the price doing right now? But on the other side, and this is what we're digging into today, you have fundamental analysis. This approach, honestly, it kind of ignores all that day-to-day noise. It's all about the why. Why is this company worth investing in? Okay, so let's get right into it. How do we find that true value? This is the part where we really have to put on our detective hats. We're not just watching the ticker anymore. We are on the case, looking for every clue a business leaves behind to figure out what it's really made of. So what is fundamental analysis, really? At its heart, it's a method of figuring out what a stock is actually worth. It's intrinsic value. It means you're doing a deep dive, looking at absolutely everything that could affect that company's profits, from the health of the entire economy, all the way down to the nitty-gritty details of who is running the show. And that right there, that's the whole ballgame. The entire goal is to come up with a number, an intrinsic value, that tells you what one share of this company is truly worth, totally separate from its crazy price swings on any given day in the market. And the whole philosophy really hinges on this one powerful belief. Look, in the short term, the market can be completely irrational. Prices jump around because of news, rumors, or just feelings. But fundamental investors believe that over the long haul, a great business will always prove its worth. Eventually, the market catches on, and that stock price will catch up to reflect its true value. Okay, so that's the what and the why. But how do you actually do it? I mean, trying to analyze a whole company can feel like a massive task. So analysts use a structured top-down process. Think of it like a funnel, starting really broad and getting more and more focused as you go. So you start at the very top with economic analysis. You're asking, is the economy growing? Are interest rates going up or down? What's the general vibe out there? Once you have a handle on that, you narrow it down to industry analysis. You know, which sectors are really set to take off? Is it tech, healthcare, maybe something else? And then only when you've found a promising industry do you finally dive into company analysis to find the absolute best-in-class player in that field. And this is where the real detective work kicks in. Of course, you're looking at the numbers. The financial reports are a must. But you're also digging into the qualitative stuff. You're asking, does this company have what they call a moat? A real competitive edge that protects it? Is the management team actually any good? Do you trust them? And can you even understand their business plan? Does it make sense? So we've talked a lot about finding this mysterious intrinsic value, but how do you actually put a dollar amount on it? All this research is great, but at some point, you gotta do the math. So let's look at one of the main ways analysts try to pin down that number. One of the most common tools is called the discounted cash flow, or DCF model. And you can almost think of it like a financial time machine. It's based on a really simple idea. $1 in your pocket today is worth more than $1 you might get a year from now. So what an analyst does is try to project all the cash a company is going to make way out into the future. And then they use a formula to discount all that future money back to figure out what it's all worth today. Now, that's the theory. And it sounds great, right? But trying to apply this stuff in the real world, well, that comes with its own set of challenges. Knowing the process is one thing. Actually, avoiding the common traps is a whole other story. So let's talk about some of the biggest landmines out there. Just being aware of these common mistakes can save you a ton of stress and, frankly, a lot of money down the road. All right, let's run through these. First, the low PE trap. Just because a stock's price-to-earnings ratio looks low doesn't mean it's a bargain. It could be a value trap, a company that's cheap for a very good reason. Second, always follow the cash. Profits can be manipulated, but cash is king. Make sure the company's actually generating real money. Third, don't ignore the soft stuff. A terrible management team can sink even the best business. Next, don't treat your financial models like a crystal ball. A DCF model is only as good as the assumptions you plug into it. Remember, garbage in, garbage out. And finally, keep it simple, especially when you're starting out. Invest in businesses you can actually understand. So after going through all of this, the question really comes back to you. Understanding these two different approaches is all about helping you figure out what kind of investor you are, or maybe what kind of investor you want to be. And this table just lays it out so clearly. You see the massive difference in time horizon, long-term versus short-term. The whole goal is different. Are you trying to find a company's true worth, or are you just trying to find the perfect time to buy and sell? One is about investing in a business. The other is about trading a stock. And that's really the key takeaway. Fundamental analysis is so much more than a set of calculations. It's a mindset. It's a whole philosophy. It's really for the patient investor, someone who is looking to do more than just make a quick buck. It's about finding truly great businesses that you can partner with for the long run. Which leaves us with this one last classic question to think about. In the short run, the market is a voting machine, tallying up what's popular and what's not. But in the long run, it's a weighing machine, carefully assessing the actual substance and value of a company. Fundamental analysis is the art of learning how to use that scale.